Welcome to This Explainer. Today, we are unpacking a massive financial shockwave that just ripped through global markets. And more importantly, we're looking at why the tremors from that exact event might be headed straight for your retirement savings. Recently, the AI market experienced this sudden, incredibly violent crash in South Korea. We're talking billions wiped out in a matter of hours. And the crazy thing is, what happened in Seoul is actually a stark mirror of what's quietly building up right now on Wall Street. Now look, we aren't here to incite panic. Actually, quite the opposite. My goal today is to dissect exactly what happened using the raw source data, break down the underlying mechanics of this crash, and show you why this is a massive wake-up call for how you view your own 401k.
But before we get into the numbers, let's eat our vegetables really quick. This explainer is strictly for educational purposes. I'm not giving you financial advice, and I am certainly not predicting an imminent global market crash. All investing involves risk, right? You should absolutely always consult a licensed financial advisor before making any changes to your portfolio. We are just here to educate, to understand the data, and to prepare thoughtfully.
Okay, let's dive into this. To really understand this huge macro event, we actually have to zoom in and look at the micro level. This is the story of Ji Young. She's a 29-year-old software developer in Seoul. Back in early 2026, she invested her entire life savings, which was about $18,000, into a leveraged ETF. And this ETF was tracking South Korea's biggest AI chip makers, specifically Samsung and SK Hynix. At the time, the AI boom felt entirely 100% real, and by June, her account had surged to $31,000. She was finally looking at a down payment for a home. But then came July 28th. In just 48 hours, her account violently crashed right back down to $18,600. The truly devastating part here? She didn't do anything reckless, she didn't accidentally hit the wrong button, she just got caught in a massive structural avalanche.
So what exactly caused this sudden collapse? Well, it basically came down to a single news catalyst. On July 28th, news broke that China had successfully begun mass production of their own deep ultraviolet chip-making tools. Now, let's be clear, this didn't mean the South Korean companies were suddenly worthless overnight, but it instantly made investors question the competitive moat of those established chipmakers. You see, hardware moats are incredibly fragile, mainly because they rely entirely on technological exclusivity. The market had basically priced in total, uninterrupted dominance for these specific AI hardware giants for the next decade. So, the absolute moment that certainty cracked, the moment a competitor showed up with viable domestic manufacturing, well, that's when the dominoes started falling.
And let me tell you, those dominoes fell fast. And it was all because of a mechanism called a margin call. When you trade with leverage, which is basically just playing with borrowed money, you amplify your gains, sure, but you also severely amplify your losses. A margin call is simply a broker's demand that an investor deposit more cash immediately to cover those mounting losses. If you don't have that cash on hand, the broker just automatically sells your stocks for you to recoup their money. Because so many retail investors in South Korea were using heavy leverage to bet on this one highly localized AI trade, just a small initial dip triggered a massive wave of automated sell-offs. That forced selling drove the price down even further, which then triggered even more margin calls across 1.2 million retail accounts. It just turned into this massive, synchronized panic loop. The final result of that synchronized panic? $290 billion. That is the combined value that Samsung and SK Hynix lost in a single trading session. I mean, just let that sink in for a moment. $290 billion. The sell-off was so violent and so incredibly rapid that it actually triggered automated circuit breakers on the Korean exchange. They had to halt trading multiple times just so investors could catch their collective breath. Ultimately, the entire equity market in Seoul lost about $2.18 trillion in value across just 2 consecutive days of trading. And this brilliantly illustrates exactly why the crash was so devastating for the whole country. A staggering 56% of the KOSPI, which is South Korea's main stock index, was concentrated in just 2 companies, Samsung and SK Hynix. More than half the value of their entire national stock market was resting on a single, heavily leveraged bet on AI chip hardware. Talk about an incredibly top-heavy structure. When those 2 foundational pillars wobbled, the entire market essentially collapsed.
Now, right about now, you might be thinking, okay, that's terrible for South Korea, but I'm in the US. I own safe, diversified index funds. I'm fine. Well, here's the hard truth. The exact same AI trade that just blew up in Seoul, it is running in your 401k right now. The structural cracks we just analyzed, the massive index concentration, that creeping retail leverage, They are absolutely not isolated to Asia. They are very much a reality in the American stock market today.
Think about it. Most Americans just default their 401k contributions into S&P 500 index funds, totally believing they are perfectly diversified across 500 completely different independent companies. It's kind of like going on a strict diet plan only to find out the meals are secretly 40% cake. Roughly 35 to 40% of the entire index's weight is actually concentrated in just 7 AI-heavy tech companies. We're talking Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. You think you own 500 equal companies, but over a third of your retirement money is riding on the exact same AI macro trend that just shook South Korea.
Now, what's really interesting here is the math. Let's break down the exact numbers for a standard retirement account so you can really see how this plays out. Say you have $100,000 sitting in what you assume is a highly diversified S&P 500 fund. Well, about $35,000 of that is tied up in those 7 tech giants, and roughly $8,000 to $10,000 of that is in Nvidia alone. If we saw a 30% localized drop in those 7 companies, which is very similar to the sudden shock we just witnessed in Seoul, you would instantly take a $10,500 hit to your overall portfolio, and that's even with the other 493 companies desperately trying to act as a buffer.
But let's move to how this builds into even riskier territory. Remember those margin calls and leveraged bets that wiped out everyday investors like Jiang? Well, get this. Leveraged and inverse ETFs made up an incredible 31% of all U.S.-listed ETF launches in the first half of 2026 alone. U.S. retail investors are increasingly being drawn into these exact same high-risk, single-stock leveraged bets, completely hoping to supercharge their returns. The very mechanism that poured gasoline on the South Korean fire, it's quietly pooling around the U.S. markets right now, just waiting for a spark.
At this point, you're probably wondering, is this just the year 2000 dot-com bubble all over again? Honestly, there is a very valid bull case for today's market that totally separates it from the past. During the 2000 dot-com bubble, companies like Pets.com had absolutely no revenue. They were purely surviving by burning through debt and endless equity raises. But the 2026 AI boom, it's fundamentally different. Today's AI leaders like Microsoft, Meta, Alphabet, they are some of the most deeply profitable companies in human history. They're funding massive multi-billion-dollar data centers entirely through their own free cash flow. They aren't out there begging the bank for loans.
So the crucial point is this: having fundamental financial justification doesn't somehow make a market invincible. Look, the internet was absolutely a real transformative technology. It completely changed human history. But that underlying reality, it didn't stop the NASDAQ from dropping 78% between 2000 and 2002. Why? Because valuations simply got too far ahead of reality. A technology can be world-changing, the companies can be highly profitable, and yet the stocks can still suffer a devastating, protracted correction if the concentration risk gets too high.
Okay, so how do we handle this information without completely panicking? Simple. We prepare. I've got 5 empowering, really actionable steps you can take today. First up, understand your exposure. Just log into your 401k and acknowledge that, hey, 40% of it might be in tech. Second, check your stock-to-bond ratio. This is absolutely vital because as you get older, you have less time to recover from sudden market crashes. Shifting a portion of your wealth into bonds provides a much-needed shock absorber for your portfolio. It matches your asset allocation to your actual age and risk tolerance. Third, if you are playing with leveraged ETFs, deeply reconsider. Seriously, those are for short-term day trading, not long-term holding. Fourth, please do not try to time the market by selling everything. People who try to call the exact top almost always miss out on massive long-term gains. And finally, step 5, fund your emergency account. Having 3 to 6 months of liquid cash means you will never be forced to sell your investments at the absolute worst possible time just to pay rent.
I really want to leave you with this thought today. Are you worried about AI concentration risk in your own 401k? Do you own heavy tech allocations right now, and has this data changed how you view them? I genuinely want to hear from you, so drop your thoughts in the comments below and let's talk about it. The warning out of Seoul absolutely deserves our attention. Not our panic, for sure, but definitely our thoughtful preparation. If this explainer helped you see your portfolio more clearly, please hit that like button, share this with a friend who might really need to check their accounts, and subscribe so you don't miss our next explainer. Stay smart, stay prepared, and I'll see you in the next one.